Okay, hi everyone, welcome back. I'm Will D. Chia here, and today we're going to talk about part 2 of investment appraisal. Apologies for the delay because I was busy and the channel is again neglected. But don't worry, I'm going to try to keep up with more regular updates. And to the students of mine doing financial management, okay, so this is an important topic to pay attention to. It might not sound important from to you in the first place, but pay attention to that. Okay, so if there are any questions, drop me an email at wildy231@gmail.com. And again, if you have any queries, please send in your queries and also do identify yourself, alright, so that it's easier for me to know who I'm answering to, okay, or who am I talking with. Okay, so let's continue. Right, the scope of today, okay, we'll look at this very important and interesting topic, that is the purpose of payback method. So this video is strictly on payback method, and we do another few more for the accounting rate of return, followed by the NPV and the IRR methods. Okay, so those will come in the following week's time. Okay, so let's look at the scope. So we are going to look at the purpose of payback method and what the different payback methods that could be used, okay, and which you must know, right, depending on the syllabus of your program. Okay, so one of those payback methods that is frequently used is known as the simple payback method, okay, followed by the discounted payback method. So both methods are a bit different, and we'll see how different they are, and finally, to end off, the benefits and limitations of both methods. And let's move on. Okay, so what exactly is the idea about using the payback method? The whole purpose of using the payback method is that it's a measure of the time required to recover the cost, and not just the cost, but the initial cost of an investment. Okay, it's good to know because immediately that tells you how soon you'll be able to recover your investment costs, especially when you have multiple competing projects or multiple competing investments. So it gives you a very clear indication of like which projects would therefore give you the quickest payback, right? And that enables management to make a decision about whether to go for projects with quick payback or maybe slightly longer payback. And of course, it's not just the payback. Management also has to consider the longer term profitability of their investments and project, okay? But that will be another set of methods. However, payback method doesn't really look at profitability. It focuses strictly on how soon you get back your investment costs. It's useful also in the sense that, especially when the company has limited liquidity, so therefore it's essential for the business to focus on projects with the shortest payback, and therefore enhance the liquidity of the business. Okay, now going on. So that is payback. Now, so let's start with looking at simple payback. Now, simple payback, the key thing about it is that it doesn't account for the time value of money. Alright, that's very important. Now, how do you know that it doesn't account for time value of money? Because you do not need to use discount rates to convert future values to present values. Okay, so there is no need to even determine what are present values. Okay, no discounting required. Let's have a look at how it could be applied on a simple example. Say for instance, an investment required an initial investment cost of 1,000. It will guarantee an annual incremental net cash inflow of 400 for the first 4 years. Calculate the payback period for this investment. Okay, to do this, well, quite straightforward, because the cash flows that will arise for the following 4 years is the same. So given that's the case, you could use the formula, which is to find the payback period, PBP. Okay, formula being the investment cost. Take that and divide it by the annual net cash flows. As simple as that. Okay, which means that would give you 1,000 divided by 400, which means that it will come out to be 2.5 years. Now 2.5 years means that this investment will require you to operate for 2.5 years before you get back all of your investment costs. Now question is, would that be a good payback? Now, you can't tell whether this is a good payback unless you're given more information, like the company requires a certain amount of payback. Then you can compare and see whether the payback here is attractive enough or otherwise. Okay, so thing is, you can't tell whether this is a good payback or not, because the question must, or even the scenario, must specifically tell you that the company requires a certain amount of payback. Then you can assess based on the required payback and what you have, whether this 2.5 years is appropriate or not. Alright, so refer to the question, and okay, so that's an example here. However, say what if the annual incremental net cash flows are not of equal amounts? Now, if you have such a case where it's different from the earlier case, annual net cash flows are not of equal amounts, then you're working to get the payback period is going to be a bit different. Okay, not more difficult, it's just a bit different. Right, so it says here that okay, we have the same investment cost, initial investment cost of 1,000. Now this will result in a guaranteed net cash inflow as follows. Year 1, end of year 1, okay, is end of year 1, not during the year. End of year 1 you get 400, end of year 2 500, end of year 3 is 600. Okay, so how long would you have to wait before you get your payback? Now there are quite a few ways that you can present the workings. It really depends on your preference and what where you're taking this, the subject at. Okay, for me, I'll do it like this. I'll have my year, a column for my year, and then I'll have my annual net cash flows. Okay, that's short form, annual net cash flows. And I'm going to have one more column known as the accumulated cash flows. Okay, so let me zoom in so that you can see this more clearly. Okay, so the beginning is 0. Okay, so when you first start with the project, the year 0 represents the start. Okay, so we assume here that this 1,000 is paid the moment you start with the project. Okay, so payments is indicated with the brackets 1,000, or you can say negative 1,000. Okay, followed by the years 1, 2, and 3. In year 1, your cash flow is 400, year 2, 500, year 3, 600. Okay, so we are going to start with finding out what's our payback. Okay, year 0, negative 1,000. So in all, we have a negative 1,000 of accumulated cash flows. Okay, going on to year 1, observe here, I have negative 1,000, but I get 400 back at the end of year 1. So negative 1,000 plus 400 gets you a negative 600. Okay, but negative 600 means that I have not recovered my investment cost. Okay, so we go on one more year. Okay, 600, negative 600, and then by the time I come to year 2, end of year 2, I get 500. Negative 600 plus 500, I'll get back. Okay, I'll still end up with a negative 100 of accumulated cash flow. Now look at year 3. Hey, come to year 3. Year 3, I'm going to get 600, and that 600 will fully cover my investment cost. Which means that, okay, this seems to tell me that the payback would occur sometime around year 2. But you can't tell exactly which part of year 2. So what we do is that, okay, how long is the payback exactly? So it looks like it's going to be, okay, payback period, it looks like it's going to be 2 years. Okay, watch here. Now end of year 2 you need another 100, but then come to year 3 you get a positive cumulated cash flow of 500. So but year 3 you'll be getting back 600 in total. So your total payback period would be 100, which is what you need additional end of year 2 to achieve payback, divide by 600, which is the total cash flow that you achieve end of year 3. Okay, sum up these two. This tells you that your payback period would come out to be around, with your calculator, if you enter that orders, that will come out to be 2.17 years. Okay, so that's how you go about it. Now if you are sharp enough, you have noticed that this calculation makes one very big assumption, okay, that it assumes that cash flows, relating to this project occurs constantly over the years, of this project, over the period of the project. So this is one assumption that is made. So, and which is one of the issues of payback method, because payback method assumes that cash flows happen predictably, constantly over the year, right? But it fails to consider that cash flows may not happen constantly over the year. It could happen like in one lump sum at the end of the year, or lump sum at the beginning of the year. Alright? So beware, right? And to add on to this is that it's, if I could put this correctly, it's over each of the following years. Alright? Be aware of that. Okay, so that is the two payback examples that I went through. One with the case where there is no regular cash flows, okay, fluctuating annual net cash flow amounts, whereas the earlier case was equal amounts of cash flows for each of the years. Okay, so that is the simple payback, and no discounting required. Time value of money is not considered. Okay, let's come to the discounted payback method. Now this discounted payback method differs slightly from the normal payback, which is the simple payback method, because in discounted payback, the time value of money is accounted for. Okay, if I say accounted for, what do I mean? It means that we actually find out what is the discount rate, and we will go on and find out what is the present value of the cash flows. Okay, so let's use an example here and see how it's done. Right, so it says here that an investment requires an initial investment of 1,000. It guarantees that there will be annual incremental net cash flow of 400 in each of the first 4 years, right? Okay, or you could say that is net cash flow of 400 in the initial 4 years, right, of the project. Okay, calculate discounted payback, and you are supposed to assume that the discount rate of 10% would be used. Now, how would this be different from the earlier calculation? Okay, for sure is that you need to find out what is the discount rate. Yes, we know that it's 10%, and you need to know what's present value. That has to be calculated. Now, how you approach this? Quite simple. The workings will be similar to the above, or it could be in whatever format that you have been taught or that you are required to perform, right, in your respective courses. So, columns, well, you have the year column, followed by the annual cash flow column. And now, because you need to do present value, you need to take into consideration the discount rate. You need to have this column known as, yes, discount rate. And you're going to have one more column, which is present value. And the last column, which is actually, okay, cumulative present value of future cash flows. Okay, so these columns that are required. Okay, so in year 0, what would be your cash flows? Okay, 1,000, negative 1,000. Okay, year 1, 2, and 3. Which we found that according to the question, it will be 400 for each of the first 4 years. Now, beware. There are cases where you may not need to have to consider the yearly cash flow for the entire period. Okay, because so long as you have achieved the calculator until the payback period is achieved, then you may not need to calculate for the rest of the years. Let's say maybe the question might say, please note that it's for the first 10 years, then you might not have to perform a calculation until the 10th year. It could be like until maybe the 4th year or something. Okay, it could be shorter. But anyway, if you're not sure, then take into account all years anyway if you're not sure. In this case, mine is for 3-year period, but I'm going to change my example a bit. I do not want 4 years. I'm going to use 3 years. Okay, the reason being that it'll be easier for you to see the effect of that. Okay, it's easier for me to explain. If you want to do 4 years, you could try that later on. Let's do 3 years now. Okay, so assume that the annual incremental net cash flow would be 400 for the first 3 years. Alright, and let's come to our workings here. 400 in year 1, 2 and 3. Okay, discount rate. The discount rate for 0, which is the start of the project, is always 1. Okay, there's a reason for it due to a formula, but if you want, you could drop me a mail to ask like how is it derived, how do I know that it's 1. Okay, regardless of the discount rate, whether it's 10%, 20 or 15, whatever percentage, is always 1. Okay, discount rate is always 1 for the year 0. Now if you refer to a discount table, okay, at 10% period 1, the discount rate would be at 0.909. Okay, according to the discount table, discount rate for period 2 would be 0.826. Discount rate for year 3, 10%, would be 0.751. Okay, you will need to refer to the discount table to be able to know what's the discount amounts are. Okay, alright, this numbers here. Okay, so this you have to derive from the discount table. Okay, so present value. How do you get present value? Simple. Take the annual cash flow, multiply by the discount rate, that gives you present value. Let's work that out. Okay, year 0, negative 1000 times 1 gives you present value of negative 1000. Okay, let's come to year 1. Year 1, annual cash flow 400, discount rate 0.909. So multiply and you find that this gives you 364. I'm using the nearest whole number or the nearest dollar. Repeat the same for year 2. 400 multiplied by 0.826. That gives you 330. Okay, repeat the same for year 3. 400 multiplied by 0.751. That gives you a remaining of 300. Okay? So now you are able to proceed and perform the workings for the cumulative present value of future cash flows. Now this is actually the same as the simple payback, just that for the cumulative present value of future cash flows, you have to calculate this using present values instead. That's the key difference. Okay, so let's start to do. Year 0, what is the cumulative cash flows? Okay, it's 1000 negative. Okay, let's look at next year, year 1. Year 1 was in cumulative present value of future cash flows, negative 1000 plus 364. Okay, what would that get you? So that would be negative 1000 plus 364, and that gives you 636. Now as you go on to the next okay, so it's negative. Now when you come to year 2, okay, year 2 tells you that that you are going to have 400 again, and then you found that the present value for that 400 is actually 330. So 636 plus 330, that would give you a result of negative 306. Okay, going on to the one more year. Okay, observe. Negative 306 plus 300, what happens? Negative 6. Okay, now this is the reason why I wanted to do 3 years. Now what have you noticed? Are you able to achieve payback? Now if you have such a case where you do not have enough cash flows, it means that you are obviously not going to be able to achieve payback. Okay, so this project, could you proceed with that? Well, that depends on the question's conditions. Okay, so obviously in this case you won't get your payback. Okay, now let's say if it's 4 years, then would we be able to get our payback? Okay, so this was the original example, 4 years. Let's see if we can get payback if it's 4 years. Okay, let's put our workings here. Okay, let's say 4 years. Annual cash flow 400. Okay, what's the discount rate for 400? Year 4, the discount rate would be 0.683. Okay, 0.683. You have to refer to the discount table for this. And what is the present value for year 4 cash flow of 400? 400 multiplied by 0.683. You find that the result here is 273. Okay, now given that you have 273 in year 4 of present value of the cash flows, then the cumulative present value of future cash flows by year 4 would end up becoming a positive. Now how do I know that? Okay, it's quite straightforward. Okay, watch. -6 plus 273 should get you 267 positive. Now what does this tell you? When have you achieved your payback? Now with this number positive 267, it seems to tell us that the payback was achieved in between this -6 and 267 region, which is actually, which period is that? Oh, that's actually in between year 3 and year 4, which means that the payback period must have been achieved. When is that? Around the year 4 period. But it's not exactly at the beginning of year 4 or end of year 4. It looks like it's more correctly to be year 3. Okay, year 3. And how many of year 3? Okay, what you do, similar to the simple payback, you find the end of year 3, you still need another -6 to achieve payback. But year 4, you will be able to get present value of cash flow of 273. So what you do is that you take 6, which is what you need additional to get payback, divided by 273. Add up, that gives you the actual payback period. Okay, so therefore it will be 3 plus 6 divided by 273. The answer becomes 3.02. Okay, again, this makes the assumption that the cash flows that happens in each of the years that you see here, like 364, 330, 300 and 273, it assumes that this happens constantly and evenly throughout the periods. Okay, so the payback in this case for my last example is 3.02 years. Is that a good payback or not? Now the answer again is that you can't tell, because you need to have some comparative number to assess whether the 3 years something is a good payback or not. Okay, generally short paybacks are good, but we can't tell whether it's a short payback unless you have something to compare against. Okay, so let's come back to the notes here. Okay, so what's the usefulness of the simple and discounted payback? In general, payback is useful, as mentioned to you before, in assessing which projects gives you quick payback, and then that indicates whether that embarking on this projects will give you for instance, better liquidity, especially those with short payback. That immediately shows you that if you go for those with short payback, that improves your liquidity, since short payback results in early recovery of initial investment costs. Okay, so simple payback is useful because generally it's straightforward to calculate, very straightforward to calculate, and then of course it uses cash flows, and cash flows we believe are far more objective than accounting profits. Right? Yes, cash flows are far more objective compared with accounting profits. So it is actually quite a preferred method, or rather it's quite a good method, not just preferred, because in assessing a project you need to use a series of methods to assess whether a project is viable, appropriate, and whether it's workable. The discounted payback is also quite similar. Basically, the key thing about it being different is that it uses discounting of future cash flows and determines the present values. Okay, so it takes into consideration time value of money. Right? Now the discounted payback method shares similar advantages like the simple payback. Okay, one of it is straightforward to calculate, and the use of cash flows are actually a lot better compared with the use of accounting profits. Okay, so cash flows are a lot more objective and far more reliable than the use of accounting profits. So that's the discounted payback. Now, so why do we need to know payback? Okay, you need to know payback simply because, like I said before, it helps you to assess which projects helps you to get the earliest payback, and then if you look at the company's longer term strategy, would the focus be on projects with short payback? If it is, then payback method is very important, right? Okay, And of course, on the other hand, knowing payback, it also enables you to see if a project could be paid off in time to come, right? Obviously, if projects can't pay off themselves in time to come, it means that these projects are obviously not very viable and not going to be good ventures to begin with. Payback methods generally are limited by a few things. One is that they are very short-term measures, right? They do not actually provide you with longer-term perspectives of whether a project is viable or not. Okay, right? If I can use the word, it suffers from the problem of short-termism, right? Focuses too much on short-term rather than longer-term, but it doesn't take into consideration the long-term viability of the project, right? That is totally ignored. And it's not just viability that's being ignored, but also projects which are profitable in the long term, right? Projects which are profitable in the long term, that aspect of profitability is not accounted for in payback, right? So payback has this very big issue. It shows you which projects could get you payback, but it doesn't show you and take into consideration that there are those projects with lousy payback, but yet they can be extremely profitable in the long term, correct? And one of which could be like if I can quote the example, like the business of airlines, right? I can imagine that airlines require heavy investment costs because of equipment and the cost of the aeroplane. These are very expensive equipment and assets to acquire, and which means that would the airline be able to achieve payback soon, maybe say in a few months time? Not very likely, but the airlines can be extremely profitable if they operate over a few years, right? So payback may not be soon for an airline, but we know that airlines generally can be profitable, given the time, right? Okay, so that's the issue with payback. Not the best method, but at least it tells you whether short term, whether an investment or project is viable. Alright. Well, the last thing, if I can say, is that it suffers from the problem of accurate forecast of cash flows. Could the forecasting be accurate? Because anything as relating to forecasting and pertaining to cash flows, this tend to be very vulnerable to uncertainty, right? Because longer that you forecast in the future, it means that there are more variables that may affect the accuracy of your cash flows, right? So without an accurate forecast of cash flows, how could you have a reliable payback figure for you to make decisions, right? So with that, okay, so that's generally payback. And finally, thank you for watching. Alright, part 3 will be coming soon, and I promise you that I'll work on part 3 as soon as I can. Okay, appreciate your viewing, and meantime, if you have if it interests you, this is my YouTube channel. Do subscribe my YouTube channel. Alright, and furthermore, if you have any questions, this is my email address. Please identify yourself if you are sending me an email. Tell me where you are, where you got my contact from, and if you are from my class, please identify which student you are. Okay, and have a good day. Thank you for watching.